Imagine a life where your investments pay you, not the other way around. A world where every single month, a consistent stream of income flows directly into your account, allowing you to cover expenses, pursue passions, or simply enjoy a well-deserved retirement. What if I told you that building an extra $1,000 every month entirely passively is not only achievable, but a strategy anyone can implement, even starting with modest capital? I'm here to show you exactly how I've been able to generate significant passive income using a focused approach with Fidelity Dividend ETFs, turning my savings into a powerful income-generating machine. This isn't just theory, it's a practical and powerful roadmap. For many, the idea of retirement feels distant, a vague concept of slowly depleting savings in traditional accounts. They might walk past a bank building, seeing it as the ultimate safe haven for their cash, unaware of the limited growth potential inside. While banks are crucial for daily transactions and immediate savings, their interest rates on basic savings accounts often struggle to keep pace with inflation. This traditional approach means your money isn't working hard enough for you, especially over decades. My journey began with a realization. I needed my money to actively generate more money. I wanted a sustainable income stream that didn't rely on selling off my principal, a fundamental shift from the spend down your nest egg mindset. Dividend investing offered precisely that, a truly passive income stream. Instead of merely preserving capital, the goal becomes owning a piece of companies that regularly distribute their profits back to shareholders. This regular payout is your passive income, your monthly reward for being an investor. Now, why Fidelity and why exchange-traded funds, or ETFs? It's about accessibility, diversification, and simplicity. Fidelity provides an incredibly robust platform with extensive research tools, low-cost options, and a user-friendly interface, making it an excellent choice for both beginners and seasoned investors. You can open an investment account and start buying shares with minimal friction. But the real game changer here is the ETF structure. Instead of painstakingly researching and buying individual dividend-paying stocks, which can be time-consuming and carry higher individual company risk, ETFs offer instant diversification. An ETF is essentially a basket of many different stocks, often hundreds, all bundled into a single fund that trades like a stock. A dividend ETF specifically holds a collection of companies known for paying consistent dividends. This means you own a tiny slice of all those companies, spreading your risk while still participating in their profit distributions. This reduces the volatility and the specific stock selection and emotional stress dramatically. My strategy revolves around specific types of Fidelity Dividend ETFs designed to provide reliable income. While Fidelity offers a range, I primarily focus on funds that either track dividend appreciation or high dividend yield strategies. Dividend appreciation ETFs invest in companies with a history of consistently increasing their dividends over time. These are often financially strong, stable companies that reward shareholders with growing payouts. Think of it as getting a raise from your investments year after year. High dividend yield ETFs, on the other hand, target companies that currently offer a higher than average dividend payout. The key is balance and understanding your risk tolerance. For instance, an ETF like the Fidelity MSCI Equity Income Index ETF or the Fidelity Dividend ETF for rising rates could be examples of the type of funds I integrate, though always do your own research. The core principle is consistent, regular contributions. Every paycheck, a portion goes directly into buying more shares of these dividend-focused ETFs. This commitment to continuous investment is non-negotiable for building substantial passive income. The true magic behind building significant dividend income lies in one of the most powerful forces in finance, compounding. It's not enough to just buy dividend ETFs. You must consciously choose to reinvest those dividends. When a dividend payment arrives, instead of withdrawing it, you use that money to buy even more shares of the same ETF. This creates a powerful snowball effect. More shares mean more future dividend payments. More dividend payments mean you can buy even more shares. This cycle accelerates over time. Initially, the progress might seem slow, perhaps just a few dollars here and there. But as your capital grows and your reinvested dividends accumulate, the growth becomes exponential. It's like planting a sapling that slowly becomes a mighty oak, bearing more and more fruit each year. Patience and discipline are paramount during this phase. You're not just saving, you're growing an income-generating asset that feeds itself. This commitment is vital for reaching your income goals. So, how do you actually get to that $1,000 per month mark? It's a journey, not a sprint, built on consistent contributions and the incredible power of compounding. Let's consider a simplified example. If you aim for a 4% dividend yield on your portfolio, a reasonable target for many dividend ETFs, you would need approximately $300,000 invested to generate $12,000 annually, or $1,000 per month. Reaching this milestone doesn't happen overnight. It requires absolute dedication to regularly adding new capital to your investment account. My personal journey to $1,000 a month wasn't about luck. It was a deliberate and meticulously planned strategy, focusing on long-term growth and consistent reinvestment of every single dividend. Starting early gives you an immense advantage, thanks to the longer runway for compounding. Even if you begin with $100 a month and consistently increase your contributions over time, the reinvestment of dividends will propel your portfolio dramatically. The "anyone can do this" part is not an exaggeration. It's about making a conscious decision, setting up automated investments, choosing the right diversified vehicles like Fidelity Dividend ETFs, and letting time and compounding do their diligent work tirelessly. Financial independence through passive income is absolutely within reach for anyone willing to commit seriously. Are you ready to take control of your financial future? Start by exploring Fidelity's dividend-focused ETFs. Open a brokerage account, research the funds that align with your goals, and begin consistent, automated investments. Every dollar you invest today has immense potential. Share your thoughts in the comments below. Let's discuss how we can all build a more secure financial future starting today.